Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an update about the economy and the investment markets. You know, I've talked throughout this year so far, and the first quarter of 2016 is almost over. A lot of the indices now, the stock market, generally speaking, is either flat or slightly up now for the year. We had about a 10-12% correction that kind of happened over a 2-3 weeks period in the month of January. And one of the things that we've done for not only our clients, but of course our radio and TV show listeners, is really just talk about the fundamentals of what's really going on. So I want to reiterate some of the stuff that I talked about back in January. First off, we never know when a 5 or a 10% correction is going to happen. They happen every single year statistically, whether the stock market, the bond market, real estate, gold. But the changes that need to be made to a portfolio only need to happen on a defensive basis anyway, when you have changing or deteriorating fundamentals on the downside. When fundamentals are going down, meaning the economy really is contracting, GDP, gross domestic product, is going down, unemployment's going up, that's bad. Housing starts are negatively impacted, going down, and things of that nature. We look at a lot of internal research, and of course we purchase a lot of research in addition, some good quality research. We spend a lot of money every year on this research. One of the things we will never do is be knee-jerk reaction. We're not going to be emotional. And what that means is just because the markets come down 5 or 10%, while nobody ever likes that, we're not just going to go and sell investments because they're down for no fundamental reason. Now, of course, if we do see deteriorating fundamentals in the U.S. economy or around the world based upon asset categories we own, we will start to get defensive. And we were spot on at Resney Wealth Management. No recession. For 2016 is what we're currently seeing. That may change in 6 months or 3 months down the road, but I will tell you right now the fundamental picture is on the uptrend. In fact, I look at manufacturing numbers now that are starting to come out for the month of March, and they're recouping and going back up into a positive trend. Housing starts are good, unemployment's going down. Things that drive our economy are looking good. Of course, we had a terrorist attack overseas as of this morning, and we had very little impact on the U.S. markets. We are not invested overseas right now at all, and we are avoiding that area simply because of relative weakness. And because of this terrorist attack now, I would firmly say that you'll probably see even weaker fundamentals in a lot of the countries that surround, that whole Eurozone. So essentially, avoid Europe. I would stay out of the emerging markets because they're going to get somewhat hurt because of what's going on with some of these terrorist attacks. The U.S. marketplace continues to be the relatively stronger asset category of choice. Again, different sectors that we look at. And also fundamentally, our picture looks bright. It should be brighter. And I've talked about this many times. The reason our economy is not growing as fast as it should is really politically driven. The Democrats and Republicans, and I know I have clients on both sides of the fence, so I pick on both parties equally. Both parties are to blame for our slow growth, over taxation, over regulation. Both parties have done a lot of bad things that really have not worked for the U.S. Consumer, you and me included. So at the end of the day, hopefully we will have a sound president coming up in the November election. I know who I'm voting for, and I've been pretty public on this. Sometimes people don't like to hear that, but at the end of the day, business matters. And if you grow the economy, if you reduce tax burden and you reduce regulation, there's more quality jobs, people make more money, and guess what, folks? Companies make more money, meaning equities go up, and we all become even richer than we currently are. So at the end of the day, I like what I see in the U.S. economy. We continue to avoid emerging markets in Europe, which we've been spot on all year. The correction we had in January basically is over, and we're basically into what it appears to be either a flat or slightly positive now for the year. And remember, as an investor, you can go through a 12, 18-month period where your portfolio goes nowhere. You see some of this, and 18 months later, you're no further ahead, and all of a sudden you get that next 20 or 30% potential increase in gain in the portfolio. That's how investing works. It's not consistent, it's not every year, and sometimes you can go a year, year and a half where things are basically flat or slightly down until you get that next uptrend. I think we are entering that phase, and I think 2016 potentially could be a pretty good year for investors who are properly positioned. If you're a client of my firm and you have any questions, please call us. If you're not a client, it's time you called, made an appointment, schedule a consultation, and you became a client. Make sure you have yourself a safe and profitable day.